Hello. Is someone there from the Equalify team?
Hello.
Hi. Uh, so I'll be sharing my screen. So can you please allow that?
Yeah, sure. One sec.
Yeah.
Hello.
Hi. Uh, so I'll be sharing my screen. So can you please allow that?
Yeah, sure. One sec.
Yeah.
Yeah, Anuswa, you are the co-host now. You can share the screen.
Yes, I'm able to do that. Please let us know when you'll be starting. So I'll be sharing my screen then.
Another 5 minutes, 5 to 6 minutes.
Okay. All right.
All right, Sandeep, Mahesh, can we get started?
Yeah, hi.
Hi, good afternoon, Sandeep.
Good afternoon.
You're joining us from London, right?
Yeah, that's right. Both Mahesh and I are in London.
Oh, okay, great. Hi,
Hi,
Mahesh.
hi. Good afternoon. Good
Good
evening.
afternoon.
This is yeah.
Yeah. So, thank you guys for joining in, and audience, welcome back to the last, but a very important segment of the Investment Products Innovation Showcase. Today, we're going to focus on structured products, as you're all aware, and we have with us FinIQ senior management team, which is going to get started with the proceedings. So FinIQ is a Singapore-based capital markets technology provider. It was established in 2001 and today caters to order management, best execution, compliance, suitability, documentation, valuation, and post-trade lifecycle requirements of over 40 financial institutions. The platform is used by nearly 15,000 bankers across 21 countries to electronically trade financial instruments, including derivatives, structured products, swaps, funds, bonds, cash equity, and cash forex. FinIQ is our presenting partner for the day, and I would like to thank the team here as well as Alok, who's not here with us today, for supporting this entire initiative and more importantly the vision behind putting up a platform like this. So on this note, I'll also like to welcome both Mahesh and Sandeep for the session. So Sandeep is already now a veteran with having participated in some of our sessions earlier. But Sandeep, I'm hoping the next session here on should be an in-person one. We've had enough of these online sessions from you. So we got to know that you are traveling to India in September, and we look forward to do something, some interesting gathering for the wealth and AIF industry with you guys in Mumbai. So quickly talking about both our speakers for the first session. Let me first start with Mahesh Bulchandani. Mahesh is the CEO and director of FinIQ Europe. And prior to this, he spent 5 years in technology and 15 years in banking in various roles at Citibank, Merrill Lynch, and JP Morgan. In his last role at JP Morgan, he was managing director and head of sales and structuring for Asia. Mahesh has an engineering degree and an MBA. Our second speaker for this session, Mr. Sandeep Sain, he retired from a career in banking in 2019 and took on a portfolio of senior advisory and consulting positions, including FinIQ and several other prominent organizations. Sandeep spent the bulk of his career in Citi in different roles and leadership positions and got his managing director title in 2008. In his 29 years at Citi, he has had the opportunity to oversee various businesses through a period of extensive strategic changes and digital transformations. A long profile, Sandeep. It's very tiring to read through the entire thing. So I'll skip most of it, but I think on the qualifications bit, Sandeep is a Bachelor of Technology, Chemical Engineering from Indian Institute of Technology, Bombay. And he's also done his Masters of Business Administration in Finance from Indian Institute of Management, Calcutta. Now, that's as good a qualification combination that you can get in India. And can't, thank both of you enough to be with us here to start the proceedings on the last segment. So just to give you a background, both of you, this entire platform was conceptualized for two set of audiences. One is the wealth advisors in India who are constantly looking for new and better products to offer to their clients. And the second segment is the investors themselves who are increasingly getting experimental with so many new products coming in. But this is where the challenge is for investors also to separate good opportunities from the wrong ones. We all know what's happening in a lot of unregulated asset classes and how, and this is not something new. This has been going on in countries like India forever. where because of the low levels of financial literacy, individuals have been losing money on various products and various chit funds and fly-by-night schemes. So we thought of creating this platform into an annual platform where we want to showcase legit opportunities, good innovative investment opportunities that are coming up in a particular year, and put it in front of the audience, both the advisors as well as investors, for them to make a more informed decision. This entire initiative was spread over 10 days. Each day we focused on a separate asset class. And today we are concluding this initiative with structured products, where we believe FinIQ is one of the best partners to tag along with, because you guys carry the expertise, the experience, and the sheer work that you've been doing with largest of the large financial institutions across the world. We kind of really looking forward to your nuggets from you guys in terms of what you see, how you seeing the opportunities globally and more specifically in India, and what the Indian product manufacturers and the ecosystem players can be excited about. So on that note, I'll hand over to now both of you. We have around 30 minutes for the session. I know we started a bit late, so we'll extend it that way. No worries. But the audience has joined us through a separate platform. So I will be happy to moderate the Q&A towards the end if we have some time. So over to you, Mahesh and Sandeep. Thank you for joining, and thank you, Anusuya, for helping us moderate this.
Thanks very much, Aditya. It's a real pleasure to be here. I think both of us are quite excited about what we are seeing in the Indian space. Now, I in fact started my career with Citi in India, spent 9 years there, and then moved to London. So I had the privilege of being part of a pretty interesting capital markets journey over the last 30 years, pretty much. So let's move on to the first slide, and let me talk through a little bit of that capital market journey of the last 3 decades, because I think it sets the context for what we really want to talk about today. So back in 1990, when I joined the bank, it was all largely manual operations. There were armies of traders and brokers through whom we had to go through a relatively painful process of price discovery for pretty much any asset class. I was mainly in the FX and derivative space, where again, it was quite complex. But it was all paper-based processes, largely voice dealing. When we talked to our clients, everything was over voice. And primarily, it was vanilla products. But it was painful from a process perspective, a lot of manual processes all over the place. Now, as we went through the 90s, I think we started seeing a certain amount of complexity coming into the market. Towards the end of 90s, you might remember that there was a dot-com bust, and that was probably one of the key catalysts for a lot of interest in capital protection. So people wanted exposure to markets, but without having to risk their capital. And that was possible through combinations of bonds and options, as many of you on this forum would be aware. So we also saw, as we got into the 2000s, some increasing automation. While pricing was still controlled by traders, there was still a certain, quite a bit of automation which started to happen. And that's when we really started seeing the advent, early 2000s, the advent of structured products, so structured investment products in a big way. Mainly at that time, it was around key themes that products were being created. But increasingly, as we went through the 2000s, the products started getting more and more complex. And it was that excessive complexity as we came towards 2008, as many of you would remember, that led to the global financial crisis. There were those, second derivative products using complex credit derivatives on subprime mortgages, which really led to it. But there were a whole host of other structures also, which I think were causing a lot of headaches. And while not going into all the details of what really happened during the GFC, I think there's been more than enough talked about and written about on that space. But really, what started happening was after the GFC, there was a huge amount of regulatory scrutiny around these products because people lost a lot of money. Banks lost a lot of money. They didn't have the right risk management. They didn't have the right disclosures. As a result, the regulators asked many of the banks in this part of the world to actually make good a lot of the customers, so which again was a huge hole for banks who had already lost a lot of money in the GFC. But around that time, we started seeing, this was the early 2010s, we started seeing huge advances in electronic trading. We saw auto trader, or rather robots, replacing human traders. and electronic dealing across multiple asset classes. And it was this multi-bank revolution, which FinIQ was very much a part of in terms of being able to provide much more efficient pricing ability and much more efficient price discovery for the end investors, as well as end-to-end automation, which finally led to a re-emergence of structured products. I think from around 2013-14 onwards, this market started recovering. And I think in India also, it had died a natural death, but across the world, it died a natural death for a while. But then it started recovering. And we've seen a large part of that over the last few years. Next slide, please. So if you look at what really has contributed to the global evolution, the first thing was the regulators started getting more comfortable. They did bring in a huge amount of regulation. In fact, some of those terms, some of those acronyms, MiFID II, PRIP, KID, these are all things we saw mainly in Europe, but across Asia, across US, Latin America, we started seeing similar kinds of regulation, which was part of the process through which the regulators became more comfortable with these products. KID, for example, is like a 40-page document that has to be shared every time a structured product is issued. So it's a key information document. And that includes comprehensive scenario analysis, risk disclosures, all kinds of disclaimers to make sure that the people who were buying these products were actually comfortable and familiar with these products. And at the same time, there was a huge requirement for technology to be playing a very important role. And that role was to create the ability for best execution through multi-bank pricing, as well as automation of pre and post-trade processes and the life cycle. Now, if you think about these products, a lot of them involve barriers, they involve coupon payments, they involve impact because of corporate actions or dividend payments on the value of the product. So tracking the mark-to-market, tracking collateral against the mark-to-market becomes a very, very important part of being able to manage the risk around these products and managing the client communication around these products. And that is exactly where automation and digitization played a very, very important role. And we'll talk about some of the things that we in FinIQ did in order to allow that to happen. The product structures themselves evolved quite a bit. There was a demise of those black box, CPPI stands for Constant Proportional Portfolio Insurance, which was essentially something which allowed the sellers of the product to say that, look, you would be capital protected with more money being invested into a particular underlying as the value of the underlying increased. But almost inevitably, it was a complete black box. Nobody quite knew what was going on inside the structure, and people usually ended up with just their capital and nothing else. So that was something which the regulators were not comfortable with. Also, post GFC, the interest rates across the world fell to pretty much zero. In fact, it was negative in the Eurozone. So the focus turned from a lot of interest rate linked structures, as well as some of these CPPI structures, to more of equity linked, which had to be partial or even non-capital protected to allow for some more value to the investors. And I think increasingly we started seeing these products starting to generate real value to the investors, which is why on the one hand, the investors started getting more comfortable with the product, the regulators started getting more comfortable. You've seen a lot of callables and reverse convertibles. That I think is the bulk of the products, and more theme-based kind of structures, which would allow people to express a certain view on the market. So the private banking kind of clients or the high net worth individuals would say that they wanted a particular view on certain stocks, and those could be created in a much more efficient manner using these kind of structured products. Mahesh, would you like to talk about what has been happening more recently?
Sure. So hi, good evening, everyone. Just kind of taking on from what Sandeep was saying before, on the regulatory front, we did see simplification of the products. And there was also a focus on making sure that the client understands the product. Now, how do you make sure that client understands the product? Again, the implementations vary from one region to another, but the broad principle is that if the client is going through a actively managed portfolio, then that manager is by nature a professional and qualified, and there are no further questions asked. But you do have several self-directed clients who make their own investment choices. And in that case, bulk of the countries, they divide the clients into two segments, and the names will change from country to country. But at a high level, we think about them as professional and non-professional. So a professional client is typically somebody who's rich, who has got the experience, has got the qualification to understand relatively more complex structures, and therefore requires a lower degree of protection. And the non-professional is, for example, my mom, right? So somebody who won't understand these complex structures and requires much higher protection from regulators. And the idea is that a client who's professional for a self-directed account must agree in writing to be classified as professional. And that's quite a key driver here. Most clients who are sophisticated would agree, because they realize if they don't agree, they will not be shown these interesting complex structures. And they also realize once they agree, they can no more run to the regulator and complain saying, I bought this product, I didn't quite understand, can you help me out? Because by signing this letter, you are telling everybody, not only the bank, but also your regulator, that you know what you're doing. Okay, so that's the way the market is getting split in two sections. For the lower level, the retail side, the products have to be even much simpler, and there has to be a lot more protection. Yeah, so that's the broad picture. Yeah, so now we can go to the product mix on the next slide. So FinIQ has a platform which is used for trading structured products. And this is the data I'm showing to you is from Hong Kong, Singapore, and Dubai. So aggregated for those three places. The reason I chose this is because this is where you see products being traded on the fly in real time. So what does it mean? If you look at any other market other than Hong Kong, Singapore, and Dubai in Asia, so if you look at Korea, for example, if you look at Taiwan or look at Japan, the way people deal there is they will create a structured product, launch it, and let everybody place an order. So I place an order for $100,000, somebody places for $50,000, do an order gathering exercise for 2 days or a week or 2 weeks, and then go and issue the note for a large size. In Hong Kong, Singapore, and Dubai, and in Europe, in Switzerland, but I have not included Switzerland data here, the way of operating is very simple. A client comes, as long as they have minimum $200,000, they can create their own payoff, and they can trade on the fly. So that requires a real-time connectivity to the market. And later on, Sandeep will show you a video clip showing how we have created real-time connectivity in Asia and Europe. Now, if you look at the product mix, and I pulled out data for 2021, and this is representing about $60 to $65 billion of volume traded on the platform. And you can see two large pies. One is called a fixed coupon note, and second is an accumulator. And again, I will not go through details of what those products are, but the important thing when you think about these products in the context of Indian market is that these products are longer. So rather than being 3 months in maturity, they tend to be between 18 months to 3 years in maturity. Okay, so they're longer products, longer dated. And equally importantly, the investor here is selling volatility in different ways. So why that is important is because when you only have principal guaranteed structures where the investor is buying a call option, the investor is always buying volatility. And that creates a problem of liquidity, because it's a one-way market. Every investor just wants to buy volatility. Somebody has to sell it. And that's what we are seeing in India currently, where bulk of the volumes are in the short-dated market. And to create a bit more kind of 1, 2, 3 year market, it will be good to get a mix of products somewhere where the client is not necessarily always buying volatility, but mix it up with products where the client is selling volatility. So from the point of view of dealers, they get a two-way flow, and they are a lot more comfortable taking some positions, knowing that in near future, they can exit that position by issuing a different product on the other side. Now, you can also see that, there are a host of other products. For example, you see a average auto call, CNST, vanilla option. They are small, and they bring the variety. It's important to have that variety. There are something like 15 or 20 payoffs which are getting dealt in the market, but bulk of it, 28 plus 54%, which is what 82%, is coming from fixed coupon notes and accumulators. And similar pattern is seen in Europe as well. In Europe, we have a auto call and we have reverse convertible. These two together make about 60-65%. So the pattern is 2 or 3 payoffs. They make bulk of the volume, and then you have small slices of other payoffs, which together kind of keep the interesting minds happy and occupied. Okay, let's go to the next slide. This is kind of a chart showing you how the volumes rise and fall. And this is very representative of what happens in a typical year. I use the word typical. I'll come back to say why I qualify it. So essentially, because this is a individual market, most individuals, they come back from their Christmas holiday in January, and they have some targets for the year. They want to make money they are very excited, very interested. Just like when we come in January, most of us, we hit the gym, we want to lose weight, we want to build some muscles, and by March, April, all the new year resolutions are kind of going away. You see a similar pattern here as well. A lot more activity in January, February, and then it quietens down. And in some parts of the world where summer is a huge thing, a lot of people are on holiday, you see a very lean August. In some other parts, you don't see that. And then, December tends to be relatively quiet. This year has been very different. When the market started in January 2022, it started on the back foot. The equity market has been down in the US, which is where bulk of the underlyings are picked from. The Hong Kong market is another area where we see a lot of underlyings, but even as you know, Hong Kong, China markets have been down this year. So the markets are more subdued. Volumes are about 50% so far compared to last year. And as we are now starting to see some of the concerns around inflation going away and perhaps some rally coming in, we might see a very busy fourth quarter. So we might see a very different pattern than what's a typical pattern for the volumes. Next slide, please. Yeah, I think maybe Sandeep, I can hand over back to you.
Yeah, sure. So I think we obviously have talked a little bit about the global context, and it's very important to kind of correlate that to what's been happening in India. And I find this somewhat of an anomaly that actually India has been at the forefront of the fintech innovation, which in many ways has contributed to the global re-emergence of structured products. In fact, one of the things I always say is that when I go to pretty much any bank anywhere in the world, we find that the structured products team will either have French people or Indian people as the largest contingent. And whether it comes to the structuring of the product, the sales of the product, the technology behind the products, I think we have been very much at the forefront. So the overseas market has evolved rapidly, especially over the last 5 to 7 years. Thanks to increasingly client-friendly structures which have actually been found to provide very good and efficient means of expressing a certain view on the market. But that, unfortunately, has not quite happened in India as yet, although we are starting to see a little bit of it. But why hasn't it happened? I think there are certain pain points. Most of us would be very aware that there's a lack of liquidity for long-dated options in India. And there are many reasons for that, but I won't go into those. But at the moment, that's a key pain point. Individual strategies for clients is just not there. I don't think it is, from a regulatory compliance as well as logistical perspective, it is not really possible. So most of the products that are being done are essentially, pooled structures where you have to build your book around it. There are still a lot of regulatory challenges around product complexity. And I think that was essentially the lessons from GFC, where the regulators were extremely concerned about the fact that individual clients as well as some of the SME corporates lost money, and the banks lost money because the risk was not being managed properly. So I think there's been like a negative reaction to that, which has not allowed for the products to be much more easily available. So it's really the concerns around the risk management framework, which I think have made the regulators more wary of really allowing this to grow in a way which the overseas markets have grown. So really, what is our mission here? And I think this is where FinIQ, we would love to play a much bigger role in terms of bringing home some of that global product expertise that we've created over the last 20 years to work with banks, brokers, regulators, and really try and create something which is going to allow for much more comprehensive product distribution. And part of that is also to have the ability to access liquidity in a way through technology which was not really possible before around structured products. So, and we want to do it with appropriate disclosures and the regulatory compliance that is required to make sure that everybody feels comfortable and there's a certain level of transparency around the entire process. And also bring home some of the risk management or risk measurement tools that we have provided solutions around for many of the banks that we work with to allow for the banks themselves or the wealth managers who are typically the ones who are providing these products today to be able to provide products and to manage these products much more efficiently, digital access to a much wider range of products, and be able to really express the kind of views on the market that we have seen as the driver of these products in the global context. So that's really what we would like to do. So let's look briefly at what is it that we are currently doing in the global context. So that gives you an idea also in terms of some of the things that have really allowed for this market to evolve much more rapidly over the last few years. So the first part, I think, is the live price discovery, the ability to see prices across multiple counterparties at the same time. As you know, these are complex products. And earlier, it used to be a painful process of price discovery where you would call up 5 banks, tell them what structure you wanted. Each one would go away, come back after 15, 20 minutes, half an hour, 1 hour, and tell you, okay, this is the price we can give you, but this is indicative based on where the market is. Then you go back and forth, try and talk to your clients. The entire process was broken, and it was not easy to do. So I think the live pricing, the ability to access multi-bank liquidity for these structures has been one of the primary drivers of the growth of this business globally. The book building and order gathering process was also quite manual across many banks. In Citi, where I worked, it was extremely manual, so it was painful. There were orders which were missed. We were trying to compile orders in different systems across multiple jurisdictions, which was often very, very complex and convoluted. So that process has become much more efficient now. The whole idea generation process. Now, if you think about it, we are trying to crystallize, or we are trying to formulate a structure based on certain views that our clients are expressing. And if you're not able to do that efficiently, then it's just not going to be possible to really do it well. So the whole process of communicating with the clients, getting their ideas, getting their views, and then creating the appropriate product to match those views is a very, very important part of the whole electronic trading process that has been created. Then, as I mentioned earlier, very, very important from a compliance and regulatory perspective, the pre-trade suitability. I think Mahesh also referred to the different kind of sectors, the retail versus the private banking sector. The pre-trade suitability and the kind of products are very, very different for those sectors. The credit checks that need to happen. So that entire process used to be manual. Now, increasingly, it is automated. So again, we provided multiple solutions around the space, including the ability to manage collateral when you, as a bank or as a wealth management provider, are dealing with multiple counterparties, where you're taking a certain amount of risk in order to provide to generate the liquidity of these products. So the whole collateral management with real-time mark-to-markets is a very important part of the automation that we provided. Post-trade processing, again, extremely important to be able to have the right kind of, let's call it, the term sheets that need to be generated, the confirmations that need to be generated. And that leads on then to the life cycle management, which I talked about briefly earlier, where there could be coupon payments, there could be barriers which need to be monitored, there could be all kinds of corporate actions, dividend payments, which can impact the performance of a product. Those need to be monitored. And again, very, very important to be able to do it electronically. And besides, the entire portfolio management across multiple asset classes, which include structured products, was a very, very big part of the functionality and features that we wanted to provide through platforms like the one you see on the screen in the middle of this slide. That's the kind of front end which we have started providing to a lot of the banks, where it's a white label front end, obviously, that they use for their clients to be able to see their entire portfolio and then to be able to do portfolio rebalancing on the fly, including all kinds of asset classes with structured products. Then the trade analytics. Again, very, very important when you think about the way that we are looking at structured products. We don't just look at them from the point of view of what's happening today. We want to look at what happened in the past, all kinds of back testing, and also try and stress test these for any kind of events that could happen in the future. So the analytics and the ability for the product and the sales team to communicate with the clients with all these, functionality in terms of the analytics around these products was a very, very important part of the automation again. And finally, reconciliations and settlements, which were again a very, very big part of regulators getting more comfortable with the idea that these products could be done suitably and without any kind of breakages in the process. So this is just a laundry list of everything that we are able to provide, from a pre-sales in terms of onboarding and content perspective, to the pre-trade process, which involves price discovery and everything else that needs to happen before a trade happens. Then the entire order flow, which I've already talked about to some extent, and really in terms of ensuring that the banks as well as wealth managers or anyone providing these products can manage the entire process of the orders coming from clients in a very efficient manner. The analytics that I just talked about, pre-trade and post-trade. And then in the entire post-trade process, a whole host of features that are required by many of the banks that we are working with to ensure that they have a very, very efficient process. And as Mahesh also pointed out, I think we are working with over 40 banks. I think that number has been increasing quite rapidly recently. So let's just take a brief snapshot. We like to talk about who are the large, this is literally our partners across the world. It's almost the who's who of the financial world. So pretty much every large financial institution is either a sell side or a buy side client for us. This is something we are particularly proud of, and we want to ensure that we can bring a lot of those solutions and expertise that we have created over the last 20 years to the Indian context. So I'm going to stop there, and we will go through a brief video. It's just a 2-minute video, which gives you a snapshot of what our platform looks like, and then we'll move into Q&A.
FinIQ first launched its EQ Connect multi-issuer platform in 2015. This platform offers fixed-based execution for Asia's most popular structured investment and OTC products. EuroConnect is the European equivalent of the same platform which is being brought to the market. Here the payoffs are more diverse. The non-flow products are covered by FinIQ SP Connect and support all possible payoffs via FinIQ UCP or user-configured products. FinIQ EQ Connect is the best execution platform for equity-based structured and OTC products. Within EQ Connect, bankers can auto-price autocalls, reverse convertibles, participation products, accumulators, decumulators, and credit tranches. On the autocall pricer, the banker can select and define the product parameters such as underlying product wrappers, important dates, early redemption parameters such as autocall coupon type, autocall trigger, Phoenix coupon parameters, define the capital protection of the product and alternate coupon. When happy with the product parameters, the banker clicks on price and receives a response from multiple counterparties. At this stage, the banker can email the best quote or email any of the non-best quotes to self. Request a KID or a term sheet. The banker can then place an order on the quote by filling in the notional and confirming other order details, upon which, the order is sent to the issuer for execution. Orders can then be monitored or tracked from the EQ Connect order blotter.
So just to finish, I think what we see is potential rapid growth in this space, in the structured product space in India, as we start getting more of this technology into the Indian context. And also, I think we find that the alternative investment funds, the whole AIF space, which uses a lot of the same instruments for the purpose of creating their structures, is also a space where some of the features and functionality and market access that we've created is going to be extremely useful. So we do see a significant amount of focus that we are going to bring into that space, creating the appropriate gateways between the buyers and the sellers of this kind of volatility, which Mahesh also talked about. And we are very excited to be working, hopefully going forward, with a lot of you who are on this forum to start creating this marketplace. I'm going to stop here and open it up for any questions.
Thank you, both of you. So audience, we have few minutes to go for the we're already running a bit behind schedule, so I'll quickly take a couple of questions. If you have any, please use the ask a question button on your screens. So Mahesh and Sandeep, will request you to just hang on for a couple of minutes.
Sure, no problem.
Sure, of course, yeah.
All right, I'll just quickly read out the first question. What best global practices can be applied in India by the companies and regulators for the development of the structured product market? Is there a pattern that India can follow?
Maybe I can take this, Sandeep. Yeah.
Sure.
Yeah.
So I would say two basic foundation blocks. One is to differentiate between the experienced or capable investors and the other ones, right? So there has to be a way of differentiating. The criteria can be different. So for example, in Singapore, the criteria is based on minimum disposable net worth, i.e. you exclude your home in calculating that. So they assume that if you are rich enough, then you can always buy advice. Okay, so that's the criteria. In some other countries, they will look at a combination of that and look at your experience. So they would ask you, how many years have you traded in financial products? Have you ever traded in a product with embedded or explicit derivative in there? So through those kind of questions, they try to understand the sophistication of the client. So once you decide that the client is sophisticated, you can give them a label. In Singapore, the label is AI. In Hong Kong, it's PI. In Europe, it's PI, but label doesn't matter. Then you have different levels of protection for that segment and the complete retail segment. Complete retail segment, I gave you my example of my mom. I would never want her to buy a structured product because she would never understand it. It doesn't make sense for her to buy. So that's kind of one foundation, differentiating between two segments of client. Second is a foundation of disclosure. The disclosure should be accurate. The documents which are given to the client should be sufficiently detailed that they can understand the risk with examples, but should not be so big that they will never read it. And that's one pitfall. Sometimes these documents become 30 pages. We all know nobody reads a 30-page document. So that's simply a tick in the box. It doesn't quite achieve the purpose. I think it's possible in a structured product to disclose the risk properly and honestly within 5 pages. It's definitely possible. So I think if we kind of draw that balance, disclose the risk to make sure that people can read and understand, but don't go to the point of just covering your own position by disclosing things which are not really relevant and creating a 30-page document. These are, in my view, two strong foundations on which you build a framework which will make sure that the market growth is robust and nobody is hurt in the process.
Sure. I see a question. I'm assuming it's from an investor. It's ideally suited for a product manufacturer, but if any of you want to give it a shot, this question about what kind of investment is required in structured products, how would be the taxation payout?
So in terms of the minimum size required to invest, I can only share experience outside India. It used to be $500,000 minimum required to create a note, simply because issuing a note had cost. That has fallen now, again, because of automation. Most issuers now are happy issuing $200,000, and some can even issue $100,000 for a structured note. Now, $100,000 is basically 80 lakhs. Yeah. In the Indian context, I think it can come down even further. Now, in some markets, to give you example, France, Italy, I originally said Korea, Japan in Asia. Over there, typical process is you launch a product and over next 2 days, you collect orders. So in that case, you can even collect much smaller orders, $5,000, $10,000, aggregate them all, and then create the minimum size required by the issuer. So that's a process possible as well. The good thing is that many small orders can be collected. The downside is that some of your larger investors who see the market opportunity, they are being forced to wait for 2 days. And in those 2 days, the opportunity may go away. So maybe you need a mix. For the larger ones who have the size to trade on their own, you give them a trade which they can do on the fly and not wait for the order gathering. And for the smaller ones, you have the order gathering and the book building process.
Sure. What is the current pipeline of your structured product solutions for the Indian wealth and asset managers?
Sandeep?
Yeah, so we are a technology provider, as you know. We are obviously not going into actually creating the product. We work with, or we plan to work with a lot of the issuers, a lot of the wealth managers, as well as some of the banks, who I think now the banks, for example, are allowed to issue these structured products globally. So we are coincidentally starting to work with some people offshore. And that includes products like accumulators, decumulators, some of those, fixed coupon notes, reverse convertibles that Mahesh talked about earlier. In the Indian context, it's still very much initial stages. I think the products that are available are largely the market-linked debentures kind of products, which are more for fundraising rather than actually providing an exposure to the market. But we see that changing. I think we are starting to see the advent of some reverse convertibles on Nifty, for example, and I think we are going to start seeing more complex products on the Nifty, or more interesting products on the Nifty coming about. But again, as a technology provider, we would work with the people who are creating the product and helping them with various features, as I mentioned. We are not the ones who will actually create the products themselves.
Correct. I think some of these questions can be taken up by our next session speakers, Ajay and Prateek. They are the ones who are running Edelweiss structured products team. Nevertheless, I think there are two questions almost similar. So I'm just going to put it up as one to you, and we'll probably end this session with this. So in your understanding, what is a better underlying product for a good structured product thing, whether it's listed, unlisted, principal protected, or non-principal protected? Two different participants have asked some similar questions. I'm just reading out one. So any of you would like to take a shot at this?
Yeah, I can take a shot. So I think the principal protected versus non-principal protected, they are very different products, naturally, right? My own direct experience as an investor has been in both. I bought principal protected as well as non-principal protected, and so far the experience has been very good. Obviously, when principal is not protected, one has to know exactly what they're doing. They have to be prepared to take the downside, and of course, you get paid for the risk that you take. So it's a risk-reward equation. In terms of a distributor, when you target your client, you want to understand, are they giving you money that is core to their wealth? If it is, then maybe you don't want to sell principal at risk product. But if it's money which they could potentially lose, of course, nobody wants to lose money. When I invested, I didn't want to lose money. But I made sure that the money I invested, if it went away, I will not be distressed. Yeah. So I think if that's the situation, then you can encourage them to go for principal at risk, because as they take risk, they get paid. There's no free risk and there's no free return. Yeah. So that's the second. What is the first part again? Can you repeat, Aditya?
Listed and non-listed, which is very much an Indian kind of scenario. And again, I won't go into the details because I wouldn't, I might be missing something here, but I think the listed ones are the ones which obviously is fully under the regulatory scrutiny, and people are allowed to do only a certain number of them each year. And again, I think the people coming after us can talk a little more about this. The unlisted, again, is something which can be more exotic. But it goes back to the point that Mahesh made. I think the non-capital protected could potentially, in a low interest rate environment in particular, provide a much better dynamics and much better payoffs, assuming that people have a good view of the markets and they can be structured in line with a certain market view. But people should be willing to risk that principal and willing to take that loss in the event that the markets go the other way. Principal protected by their very nature, because the bulk of it is going to be in a zero coupon bond, you're not going to get the same kind of return. Although with high interest rates, you can still get pretty decent structures even with principal protected.
So I would have loved to take more questions, Sandeep and Mahesh, but we're really out of time. I think our next speaker is also here. So we'd like to, we'll have to conclude this session, but would love to continue engaging with you guys in more similar sessions, hopefully over the next few weeks. And we have an in-person session definitely scheduled during your visit in September. So I think that could be a good gathering for industry and all interested participants to come together and have a good evening of conversations with FinIQ team. So thank you so much for joining it, both of you, and we look forward to keep engaging. Audience will quickly move on to our next session.
Thank you, everyone.
Thanks very much. Bye-bye.
Thank you. Bye. So our next session speakers already here, Prateek and Ajay.
Hi.
Hi.
Hi, Aditya.
Hi. You both are hosts now. So, you have a presentation that you'd like to share?
Yes, we will run through a deck, but I think it's just to guide the conversation. So,
All right. So audience, this our first showcase and also the last session for the day, as Nikunj, who's supposed to do the second showcase from, is not going to make it. So so we have the showcase session from the Edelweiss Wealth team, and we have with us Ajay Vora, who's the head of listed equity alternatives and investment management with Edelweiss Wealth Management, and Pratik Mittal. He's the head of structured products and business development in the investment management team of Edelweiss Wealth Management. So welcome, Pratik and Ajay. And we have around 30 minutes for this session. You already know the format. I'll be happy to moderate in Q&A, if any, towards the end of it. Over to you.
thank you so much, Aditya, for having us. And it's a pleasure to be speaking to all of you here, and a very good evening. So, without further ado, let me dive right in, and I'll basically start off by setting the context for how we think about structured products, and why they essentially are something that Indian investors do need, right, in their portfolios. So, and from there, I'll just give a brief background of our desk, right, which is now more than a decade old. So very, very quickly, I think structured products as a product is something which is, as mentioned in the last session as well, it is still in its infancy stage, if I can say. Primarily, if you look at the allocations of investors anywhere across the world, right, structured products tend to form an allocation of anywhere between 10 and 30% of investor portfolios. Whereas when we would look at similar statistics for India, I think that number will be like barely 1 or 2%, right? That too only in the HNI audience. And so there is a significant value that these products provide. Where that value really comes in is that, SEBI coined a name for these products, structured products. SEBI called it market-linked debentures. I think that's the cornerstone of the value that they provide. They are essentially debentures, right? When you say debenture, it means they have a fixed return orientation in them, which means they have the ability to protect your capital, right? So it is more like a fixed income instrument that you purchase. However, the coupon, right, traditionally on a fixed income instrument is fixed, right? The variations are what frequency you will receive that coupon at, right? But what changes with structured products or market linked debentures is this coupon is then linked to some underlying market. And again, globally, these markets are across all possible asset classes. So you will have structures around obviously equities, you will have structured products around rates, you will have structured products on commodities, currencies. So the whole, like any asset class that you can imagine, there will be products available on those. Whereas when you bring that to the Indian context, India is still, I would say, 95% is oriented towards fixed income, and maybe a 5% share towards equities. Within the 95% fixed income oriented structures, the underlying can vary between a GSEC and some sort of an equity underlying for a certain kind of kicker. But I think that's sort of the length and breadth of the underlyings that we see. And sort of that's what actually brought us to think about the product that we'll be sharing with you in a bit. So as I said, I think that's the cornerstone of this. They do enable very, very unique diversification in your portfolios, because all the investments that you make either carry absolute fixed income nature or absolute equity. But for an investor who is looking to participate in equities, but let's say the risk never, sort of fits their appetite, right? And for that reason, they tend to stay away. Again, looking at a structured product with an equity underlying, you can maybe participate in equity markets like Nifty, but with capital protection on the downside. Now that is a feature that is absolutely unique to these products and potentially can open doors for a large number of investors, right, who still are, sitting on the fence from the equity markets. Obviously, these are tailor-made solutions, so they can be customized depending on the market view, depending on specific requirements for large investors as well. Also, they are technically more efficient investments versus traditional fixed income, both in terms of the coupon being linked to an underlying market. So, for example, even if you do a rate linked structure, right, you can benchmark it to, let's say, GSEC. So if the rates go up or down, proportionately your the coupons that you are earning from these products can help you tide over varying levels of inflation in the market, right? And lastly, I think the issuance structure for these products, etc., has also evolved. There is most of these instruments issued in India are now in a secured format, right? And there is a high level of due diligence that is done on the asset cover, all the covenants by an independent trustee for each of these issuances. So all in all, the unique investment strategy coupled with the regulatory framework, the entire due diligence framework for issuing of these products, I think the stage is set for structured products in India to take off. I think we would love to be part of this journey. So just very quickly giving you a rundown of the desk at Edelweiss Structured Products. So we have, I would say we would be one of the, longer sort of journeys in this space. The desk was started in 2007. We would be, the first Indian entrant in the market-linked debenture segment. There were a lot of MNC banks, which had entered the markets before. Obviously, given their global experience, they're the ones who brought this product to India. And I think given Edelweiss's capabilities on the derivative segments and our understanding of the same, we also chose to, operate in this right from 2007. We have over these 15 odd years issued more than 21,000 crores, so close to $3 billion, right, worth of issuances over these years. And out of that, we have redeemed successfully, 15,000 plus crores. So our current book would be just over 6,000 crores. I'm happy to say that all 15,000 crores that we have redeemed performed as promised. Whatever payoff we had promised, we were able to generate the same. We were able to make all our payments on time. So I think it has all in all been a successful journey, and with the products achieving their intended investment objectives. So again, in terms of track record, it's a quite successful track record. Also, we have over these years, the idea has not just been to be there, but to also expand the market. So we have actually built a robust network through the private banks, wealth outfits, multifamily offices, who typically cater to advise HNI and ultra HNI investors. That's primarily been the target audience. Also, of late, we are seeing increased interest from corporates and as well as institutions in these products. As I said, these are highly customizable. And yes, definitely. So, one of the points that was made was market-linked debentures in India today are being used as a fixed income alternative largely. But, we continue to remain one of the oldest and the leading sort of players with capabilities around equity-oriented products. So, which is why, the product that we are going to be discussing with you now is something that comes as a genesis of or is part of our attempts to really kickstart, catalyze this journey of true blue market linked debentures to grow and develop in India, right? And so without further delay, I'll hand over to Ajay Vora. So Ajay, if you will if you can take us through the product offering that we have created, and
Sure. Thanks a lot, Pratik. So I think as Pratik also mentioned, and I think the earlier speaker was talking about it, that in India, if you look at it, most of the products which are being offered has, the underlying will always has most of the times been Nifty. But over here, we just thought of this whole idea where if a particular portfolio is able to deliver far superior returns than the benchmark indices, the investors should get the double benefit. One is the overall, the benefits from the structured products itself, the features which it offers. And secondly, the outperformance of the portfolio versus the indices. And so what I'll do is, to start with, I'll talk about why we feel our portfolio can do relatively better versus the index. And then maybe again, Pratik can talk about how we have structured the product basis our index, basis our portfolio. So LEAP is a index, which is nothing but our portfolio, right? And this is constructed on a certain thought process basis, our understanding of the market. So I'll just briefly talk about our thought process and then the strategy. So if you look at, the Indian markets is definitely a growth market. And when the growth accelerates, you'll see, a market's doing pretty well. But at times, we are also stuck in a very, a very narrow band of earnings, where because of many factors, the overall Nifty earnings growth has remained subdued. And that is what, if you look at, from FY17 till FY20, you will see that, the Nifty earnings was broadly in the range of around 400 rupees to 450 rupees. So over a period of 3 years, the EPS moved just from 400 to 450. And therefore, the returns were also not that great. But post-COVID, if you look at it, Nifty earnings moved from 450 rupees in FY20 to almost 530 in FY21 and straight away to 730 in FY22. So the journey has been fantastic over last 2 years, where we moved directly from 450 rupees EPS to 730, and that is the key reason why we see why we saw a very sharp move in the Nifty as well. And along with that, came the overall multiple expansion, the valuation expansion, which helped Nifty almost double over a period of 2 years. But now, if you look at it, going forward, things are normalizing globally as well as in India. And we'll be again back to, that 10-12% earnings growth, because, some sectors would be doing fine and some sectors would be doing great, whereas some sectors would not be doing that fine. So the point is that, all those things will come together, resulting in Nifty earnings likely to be pretty much in a range of around 10 to 15%, rather than a very high growth period which we saw earlier. And so if you can just move to slide 14, Pratik. And therefore, if you see, what is, so generally in each of the phase, historically, we have seen that although, the Nifty earnings has been subdued, say in single digit or low double digit, but there would be n number of sectors which, performs pretty, almost 2x, 3x that of Nifty. So if you look at in 11 to 14 phase, you'll see that, sector like IT and consumer staples, they were growing at almost 3x that of Nifty. And sectors like financials and materials, they were underperforming the Nifty, right? But in March 14 to March 17 phase, if you look at it, financials and materials were growing at almost 22 to 25 versus Nifty growth was only 13%. So the point what I'm trying to drive is that, you'll always see a mix of outperformance and underperformance from the large sectors in different phases. And therefore, the Nifty earnings may remain, subdued. But if you are able to construct a portfolio which is more growth focused and identify the sectors which can grow 2x, 3x that of Nifty, it will be, endeavor to deliver a decent alpha over and above the benchmark performance. So a very classic example, recently we saw that, post March 20 till almost 22, or I would say late 21, December 21, we saw IT and metals being the best performing sectors in the country, and suddenly, over last 5 to 6 months, both the sectors have been underperforming in a big way. So I'm just trying to give an example that while constructing the portfolio, we need to be sure what theme which we are playing in. And maybe if you go right to a very large extent, the outperformance on the portfolio can be pretty significant. And so this is how we construct the portfolio. So right now, these are few themes where we are extremely positive about, and basis that we align the portfolio so that although some of these themes may not be part of the benchmark indices, but if you are able to capture them early, our portfolio, which is the LEAP portfolio, which is an index, can outperform the index in a pretty significant way. So, capex recovery is very much visible because of the government actions, government capex, private capex announced by n number of industries, the PLI schemes announced. So when this whole theme picks up, you'll see the entire banking sector also start doing well, and lot many other ancillary industries also start doing well. So, the clear example is that if you look at the credit growth, which was around 5-6% few quarters back, has moved to almost 15%, both on back of retail demand as well as corporate demand. So these are few sectors, which falls under the part of capex recovery where we are positive. Then you have the entire housing sector. So we feel that, the whole real estate sector in India is coming out of consolidation after almost like 10 years. The number of players have gone down by 70%. And there is a completely different affordability which has come up in the country, resulting in, a multi-year, multi-quarter high sales numbers. So just to give you a sense, last year, India as a whole sold close to 650 million square feet, whereas in the first quarter itself, India has sold almost 200 million square feet. So you can see that, the growth rates are pretty much visible. And as we all know, housing is a very large part of the Indian economy. So once that triggers, you need not play only through the developers, but there are n number of industry which ends up benefiting through this. And similarly, we can talk about the electric vehicle, which is very much known to everyone, but to a very large extent, it is not part of the, you can't play that theme through the index. And similarly, defense is not very much part of the overall index. So these are few themes which we keep in mind and where we turn positive and, ensure that our portfolio is aligned to these themes so that the LEAP index ends up outperforming the overall benchmark index, which is the Nifty. And then it's the structuring which we do eventually, which will help the investors benefit from this particular. So before we get into the structuring, I'll just spend a couple of minutes on how we construct the portfolio. So we have a universe of close to 120, 130 companies. And honestly, these are pretty hygiene factors basis which we select the universe. So basis, the economic modes and the competitive advantage of the company, the track record and the governance history of the management. And eventually, the valuation is what matters a lot. So basis all these things, we select a universe. And then as we discussed, just a few minutes back about the theme where we are positive, we select a portfolio, we select the stocks and construct a portfolio of around 25 to 30 names, which can have a mix of around 70% large cap and 30% mid cap, where we restrict our overall weightage is also a maximum weight of 8% and minimum of 2%. So this is how we construct the portfolio basis the quality stocks and the valuation and all, where we see on a at least 2 to 3 year basis, the compounding can be far higher than the Nifty compounding. And what we have done is we have, assigned this whole thing to CARE, who manages our portfolio's index. And one can see the NAV of our portfolio on their website on a daily basis. So they can completely get a sense in terms of how we are performing versus the benchmark. And maybe now Pratik can talk about, how we have structured this basis the LEAP index.
Absolutely. Thank you so much, Ajay. So the opportunity here, right, and the genesis of this thought for us as one of the players in structured products, we've been structuring products for I think over 10 years on Nifty, and Nifty would be a very, very large part of the equity book, right? But whenever we are actually discussing, right, or we are exploring the equity or, what are the options available to investors to invest in, and what are the criteria that people evaluate, right, when they choose where to make their equity investments. The first parameter that comes up is whichever fund house I am investing with, what is their track record. The idea behind looking at that is you want to go with someone who is consistent, who has consistently delivered alpha over the benchmark, right? So it's a large cap fund. You want the manager who has consistently delivered alpha, ranks amongst the top in that category. So we said that, we've been trying to solve a problem where we've been structuring products on the index, something that anyone can buy right through an ETF format. It's basically out there for anyone to purchase, but it is a much smaller set of investors who are looking at the index, but the rest of the money is only chasing is only focused on your ability to generate alpha, right? And I think that's where we really thought of bringing these two things together. So if you can bring in the alpha generation that a fund manager can do by choosing a particular investing strategy. So in this case, we have Ajay, a very experienced equity investing professional, and a unique approach to sort of building an index or a portfolio, right, of equity investments. And then we overlaid it with structuring of a structured product, right? So what we have basically done in this case is we basically brought in the underlying from a Nifty. We changed it to this LEAP index. Now LEAP is a custom index that we have created in-house. Technically, we have the ability to create or structure these products on any given index, and we have also done the same with some other managers as well. What we do then is we actually synthetically create options on this, and we package it inside a market linked debenture. What that enables us to do is we are able to offer an investor the opportunity to invest in this equity portfolio, right, through a structured product. But either you can go for a low risk version, as we were discussing in the last session. You can go for a capital protected structured product, right? If you choose to go for capital protection, we are able to structure participations on this index to the tune of around 100 to 110%. So at least you are getting the full upside of the equity index, or maybe a 10% extra multiplier. But on the downside, it comes with capital protection. So in case, let's say, over a 2-3 year period, depending on different products, over a 3-year product, 3-year tenor, let's say, this index were to actually fall, right? Irrespective, your capital will be protected. So that minimum capital will at least come back to you. But in case the index performs, then whatever performance the index generates along with the alpha over its benchmark, you will get the due percentage or participation on that on the upside. We also did constructed a higher risk. So there are a lot of equity investors who are also looking to basically get better beta on the markets, or to basically get better participations. And so we created a portfolio with the same risk, which is 1:1 downside on the market on this index, but on the upside it enables you to get between 1.4 to 1.6 1.65x of the index participation on the upside, right? And I think that basically we are able to do, given our experience on the structuring and the derivative side. So obviously it's a slightly more nuanced approach. So to make something like this work, the universe, while the inputs come in from the fundamental aspect, you also have to bring in the structuring aspect of this product to really look at stocks which are available in the F&O segment. What is the kind of liquidity that is available, what's the kind of open interest that you're seeing over a period of time. So a detailed amount of and a large amount of due diligence on that is required to really then bring these two together to generate and create a portfolio like this. So just to give you a sense of what this looks like, as I said, this is just one of the examples wherein it enables you to participate in the upside of this index. So you get to participate on the positive side with a 1.65x multiple of the index returns. There is no cap on this, so it's an uncapped return. If tomorrow you have a runaway rally for the next 3 years, whatever this index generates, you get 1.65x of that, right? You get multiplied returns, which means faster growth via additional alpha. Instead of a 1x, you are getting that 65% extra. But on the downside, it comes with only 1x of the downside. So what that basically means is, let's say if you had bought any long only fund, you would participate in the upside of the fund one time and the downside one time. But in this case, there's an equity portfolio on which you are participating, or on the downside, you're still getting a 1x risk, but on the upside, you are going to earn, let's say, a 1.4, 1.6x of that fund's return on the upside. That's what it looks like. So if, let's say, this index were to return 20% over, let's say, a 3-year period, this product would give you 33%. So 20% multiplied by 1.65x, which basically is the kind of multiplier. But as you can see on the downside, if the index were to fall by 20%, you would still lose only 20% of the capital. It's a 3.5 year product with a market position or for 3 years. It's the underlying, as I said, in this case is the LEAP index, and it's a secured paper with 1x security cover with a charge created in favor of the independent trustee. And as I said, this is the principal not protected version. These do, given the higher risk, these come at a higher ticket size to investors as well. Also, these products, when you offer them without capital protection, you cannot offer, you cannot get them listed, because the guidelines in India mandate that only capital protected instruments, market linked debentures, can be rated by the agencies, and only rated instruments can then get listed. So I think that's basically the new product, which I think which is the latest offering from our desk, and something that we feel is the right direction for this market to take, and we hope that we are able to share it with the right sets of investors, and people are able to benefit from an offering that really combines the best of both worlds, right, for investors. Ajay, you want to add anything?
I think, Pratik, we have given all the details regarding the product.
Great. So Aditya, I think over to you.
Yeah, so I'll request the audience to take the Q&A questions directly with the Edelweiss team separately, because we are out of time, and I'm sure the audience was also, whatever calendar they had booked for this entire 2 sessions, they will have some other engagements after that. So audience, Pratik and Ajay, can you share your, have you shared the contact details where audience can get in touch with you?
Sure. So you can just note down my email ID. It's Pratik, PRATIK .Mittal, MITTAL @Edelweiss, EDELWEISS fin.com.
I believe LinkedIn would be a good way to reach out to both of you, or anyone from them.
So, absolutely. So we are there on LinkedIn, and please feel free to drop us a message. Happy to take any questions. Yeah.
So thank you so much, Pratik and Ajay, for very, very insightful talk. And with this, we come to the end of this inaugural investment products innovation showcase. Audience, those who missed out the videos, our team has already started uploading the session videos on our YouTube channel. So you can like and subscribe to that for all future updates. And Pratik and Ajay, thank you so much for the time and efforts you put in. I know sessions like this during a busy day, especially when you have a long weekend in front of you, still taking out time and completing taking efforts for something like this is huge. So looking forward to engage with you guys more, and hopefully having some in-person sessions for the audience, the distributors, as well as the investors who would be interested in your products. I wish you all the best, and thanks again.
Thank you
Thanks
so
a lot.
much for having
Thanks,
us.
Aditya. Thanks.
So thank you, everyone. And with this, we conclude the IPI 2022, and we look forward to see you at the next event. Take care. God bless.